Hello, friends. Welcome to the Weekend Investing Stock Market Weekly Review for the week ending 13th of March. We had a short week. We had holy celebrations on Friday, and the markets were about flat this entire week. From our research desk this week, we had these fantastic stories about sector rotation being the absolute truth of the markets. Uncorrelated asset classes are a must in your portfolio. A study on Indian capital gains. Are they really that much? Inflation adjusted CNX 500. How we should not let go of opportunities. Shallow drawdowns are a norm now. Why RFI is not buying, and you can start investing anytime. These were some of the stories from the research desk this week. You can watch them on the Weekend Investing app, or you can read the daily newsletter, and and you can get to these stories. Disclaimer: please read fully, and please do subscribe to the channel. Nifty this week 0.69% down. Um, I would not complain too much about this. I think we had some really bad months going on, and any flat terrain for a week is always welcome. Although the downward move does not seem to be ending anytime soon. On a weekly basis, we are within this, you can say, consolidation congestion zone of 21,800 to 22,800, and only once we start to break up above it will we really sort of be seen to be breaking out. So a small ranged candle for the week after a bounce week last time. But nevertheless, on a monthly basis, we are still looking down on a month-on-month basis, and that is something that you want to break that particular chain of down moves. In the mother market, the US market S&P rose on Friday night. Uh, all executive orders, or let me say most executive orders that President Trump is signing, are getting challenged in courts there. So a lot of this Doge Fed job cancellations are also getting challenged. So there seems to be a narrative of ineffectiveness of a lot of things that Trump is saying, and hence, if that is made ineffective, then a lot of tariff talk probably also may or may not go through. So that is sort of some confidence that came back. But nevertheless, for the week, S&P was down 2.2%. Quite a bloody week in the last 4 weeks. 4 bloody weeks there on S&P 500. Gold is up 2.39% this week. Gold has closed on a all-time high on dollar weekly charts at nearly 3,000. In Indian rupees, we have closed at 88,000. And gold is that only one place, gold and silver, you can say, where money is actually flowing into, and it is purely because liquidity is flowing into gold and gold is going up. Any market that goes up is because liquidity is flowing towards that, and there is a reason for that flow. The reason for the flow here is that gold is being seen more and more as a very important monetary asset, not just by central banks, by institutions, by pension funds, by ultra high net worth individuals, by retail investors. Everybody is realizing that they are not having enough gold. Person who has zero gold wants to get to 2%. Person who has 2% wants to get to 5%. Who has 5 wants to go to 10. 10 wants to go to 20. And people are not satisfied even at 40-50%. There are many of those gold bugs out there. So uh, this 60-40 equity debt combination portfolio that has been very prevalent for the last 40-50 years globally is now seeing that this 40 component is not actually acting as a hedge to the 60 component. So 60 was equity, 40 was, let's say, treasury bonds. So treasury bonds are not really an effective hedge, and hence some part of that is going towards gold. And the same thing is happening in the central bank balance sheet also, where the balance sheet asset side, gold is getting either people are talking about revaluation of that gold or addition of gold, and many countries are taking possession of their gold. So I think there was a number, I think 13 or 14 countries in the last 2 years have taken possession of their gold. They're withdrawing the gold back from Bank of England, from federal holdings in New York. And this is showing you that the world actually is deglobalizing very, very fast. Nobody has trust anymore on anybody else, especially with their asset, because gold is that one asset class which cannot be sanctioned. You can sanction dollar assets of Russia in XYZ country, or if you're holding treasury bonds, US government can just sanction those, but gold which is in your possession cannot be sanctioned. So the theme is that more and more countries will move towards gold as part of their allocation in their balance sheet. And just to go back to where they were few decades ago, it will require a massive purchase of gold, and that is what exactly is happening. The liquidity is coming through. The dollar index was flattish this week, but it has been falling. So this is actually good news going forward for emerging markets and for precious metals. Only when dollar index is falling do we find uh, gold and emerging markets move up. So benchmark and sectoral indices performance, let's look at those. um, so this last week we had small caps and mid caps still losing more than 2%. Nifty next 50 almost 2%, Nifty 500 1.3%, and Nifty 50 minus 0.65%. In the last 1 month, we've had 2 to 6%, 2.75 to 6% fall. In the last 3 months, we've had 10% to 23% fall. And in the last 6 months, we've had 12% to 24% fall. So it's just been a very, very red last 6 months. If we see last 1 year, we are still somewhat minor green, so that's not too bad. And if we look, 3 years, we are quite nicely in double digits in all of this. So 3 year and 5 year are looking very good, and that usually happens. So anytime you see a 3 year or 5 year period chart, you will find that there are reasonable gains made, especially if you're coming through SIPs, and this is point to point one time sort of investment return. So SIPs can be even better. So have the long view, and don't worry about the short term nature of the market. In the last 1 week, defense, financial services, and FMCG did not fall, although they did not go up much as well. But all other sectors actually fell down. IT the most at 5.3% fall. Capital market has been losing ground. I mean, if you see capital markets over last 1 month, is down 12%. IT is down 12.6%, and 30% fall in capital market stocks in last 3 months. So capital market has been hit really badly. Real estate also hit really badly at 26%, and IT is down 21%. If we see this picture of 1 year, and remember the Nifty and the other indices picture of 1 year, everything was green. But here you can see energy, PSU banks, oil and gas, FMCG, real estate, IT, public sector enterprise all have lost ground, and several of the sectors have been extremely flat, and only some sectors, defense, capital market, tourism, metals, have really done very well. But now that trend is reversing very, very rapidly for some of these sectors. And you can see financial services is in the top momentum score across different frequencies. So financial services, metals, commodities, pharma, and defense, these are some places where the consistent top performing has been there. Pharma slipped very badly recently but has come back, and defense has also come back. So these are the ones that are coming back. In the very short term, you can see oil and gas and FMCG is also recovering fast. What's falling is private banks have fallen in the recent times, and so has MNC companies and public sector enterprise stocks. So drop from 52-week high stats. So in this chart, we look at what is the drop from 52-week highs to now. So small caps, if we see, bulk of the small caps, that is 30, 56, and almost 74%, 75% of stocks are, 30 to 50% or more um, in terms of fall from 52-week high. Only 4% stocks in small caps are less than 10% fall. In Nifty 50, you have 12 stocks, 12% stocks. That's about 6 stocks which are less than 10%. And most of them are 10 to 30% here. And you have very less in the 30 to 40 and 40 to 50 and 50 and above range. And in the Nifty next 50, however, you have a bulk of the stocks, 50% stocks, and let's say 18 and 2, 70% of stocks which are down more than 30% within Nifty next 50. So this time, because the rally was probably very hard also, the falls from 52-week high have been steep, and that is creating a very uh, sort of a scary picture, like this table, for instance, that markets have really not done well. But when we see it in context, that where these stocks had gone from, in 3 years and 5 years time frame, then if you see what is the CAGR of any of these stocks in 3 to 5 year time frame, you'll find that that figure is not looking bad at all. that figure is not looking bad at all. It is only the drop from 52-week high which is really looking really bad. And there is little you can do about it but to manage your positions as per your exit plans. So how many stocks are outperforming or underperforming the CNX 500? So let's see, in 500 stocks, 17%, 18% stocks have dropped. Uh, Sorry, the benchmark, the current drop from 52-week high is 18%, and the average drop from 52-week high of all stocks in this CNX 500 is 34%. So there are stocks that are underperforming, and there have to be stocks which are outperforming. Otherwise, this 17.8 figure will not arrive when the average is 34%. So there are 56 stocks in the CNX 500 that are stronger than the benchmark. 444 are, of course, weaker. There are 363 stocks that have done better than the 1.5x of the benchmark drop. So 363 stocks have done 1.5% of 17.8 or more. Stocks more than, let's say 35% are 226, and stocks more than three times this are only 35. So bulk of the stocks are in the region of uh, more than 1.5 to 2 times the benchmark drop. And these are the stocks that have done better. So less than, let's say, 50% of benchmark drop. So that will be about 9%. So 0 to 9% drop, you have 19 stocks. So which is quite good actually right now. Let's say 0 to about 14% is 31 stocks. So in all, there are about 50 stocks which are in single digit, or let's say 0 to 15% drop from the top, and one should be looking for hiding there. That's a defensive part of the CNX 500. If you look at the benchmark and sectoral indices, then you can see that the trend is not improving at all. In fact, it has gone flat on the SMA 200, the 200 DMA, and only 12% stocks are above 200 DMA, which is very low actually. And if you look at 50-day moving average, this average has also now come down a little bit in the last week and is now sitting very near the 200-day moving average. So both of these are actually not showing any signs of any life going up. If we do the trend check on benchmark indices and see 200 DMA, again you can see most indices have very few stocks which are above 200 DMA. I mean, 10-12% is nothing basically. So let's say in Nifty 50, Nifty next 50, you have 5 stocks which are above 200 DMA only. In Nifty, you have 10 stocks above 200 DMA. In mid cap 150, you have perhaps 18 stocks that are above 200 DMA only out of 150. So the numbers are very poor. But yes, there are still some stocks that are there, not yet completely smashed down under the 200 DMA. If we do the trend check on sectors, you can see financial services has 45% stocks above 200 DMA, private banks has 30%, services 26%, metals 20%. Rest you can't even talk about them because there are so little. There's basically stock specific moves happening in other sectors. But in financial services, you can say about half the stocks are above 200 DMA. So that sector is still having some breathing space and life. Private banks, about a third of them are above 200 DMA. Not good, but much better than, let's say, real estate, which has no stock above the 200 DMA, or energy sector or public sector enterprise. I mean, these are completely demolished. And autos, metals, not metals, autos, media, IT, FMCG, oil and gas, these also have very little number of stocks which are about 200 DMA. So these sectors are not the sectors to really look at. You should try to find setups within these sectors where there is a potential that you find stocks above 200 DMA. If we talk about strength and weakness within the CNX 500, then the golden cross, which is 50-day moving average greater than 200-day moving average, is on 18% of the stocks. So 92 stocks satisfy that, which is still okay. Absolute strength, where price is greater than 25 DMA, which is greater than 50 DMA, which is greater than 200 DMA, is only 12 stocks. So we should find these 12 stocks and try to find setups here. This is only 2% of the CNX 500, and that is where the current strength absolutely lies. Of course, on the flip side, you have death cross on 409 stocks, and absolute weakness is there in 281. So very high percentage of stocks that have been completely demolished. This is complete demolition where 250, 25 and price are in that particular uh, stacking. On the FII DII stats, we have continuous selling by FIIs. Although in the last four sessions, I would say there has not been a single session of a very large sell, like 4,000 crores kind of sell. The largest one is 2,800 crores on Monday, and then you have had a mild 485 and a 1627 and a 792. This is even lower actually than most days. On the DII front, you had a low day at 263, but then you had 2000, 1500 and 1700. So DIIs have pretty much not only fully absorbed the FII sales but have added more. So if we see the cumulative figure, you can see very clearly the DII flow is moving up. If you remember, about a month back, we had equal DII and FII numbers on the opposite side. So minus 70 versus plus 84. So this number has not been as uh, you know as different as this as we are seeing this time. It was very close, minus 70 to plus 72, minus 75 to plus 77, almost mirroring each other. But this time, in the last few sessions, you are finding that the DII flow is still maintained, whereas flow is getting shallower and shallower. So that's all the data I have for this weekly review. I hope you like the content here. Please let us know if you don't like some content. We'll try to change that, or give us more suggestions what data you would like to see. And please do subscribe to the channel. Please do share these videos, and do comment in the YouTube comments on how you like this content. Thank you so much. Bye bye.